Hi, I'm Chloe Carruthers here with Barry Norris, the fund manager of the Argonaut Absolute Return Fund, here for our June update. Barry, it was another rollercoaster month for the markets. How did the fund perform and what were the main drivers of performance?
Well, the fund was down 7% in June, which compared to the market that was down 8% and a peer group that was down on average 2%. Our longs and shorts were down roughly around the same amount during the month, but by virtue of our 2-to-1 ratio of longs to shorts, the fund also went down. So it was the first month in 10 that the fund had lost money, and that was primarily because commodities, which were obviously a big part of our long book, also entered a bear market during the month.
What was the significance of the Federal Reserve communication during the month?
Well, I think although the market was expecting more Fed tightening, the Fed spooked the market by changing its previous plan of hiking by 50 to hike by 75 basis points in June and to signal another 75 basis points in July. So much faster pace of tightening than the market had anticipated. So the willingness of the Fed to tighten so dramatically and their language around restoring price stability being a bigger priority than the economy or employment in the short term means that the market is now preparing for a recession and for the Fed to keep tightening until the global economy breaks.
And what changes did you make to your portfolio over the month?
Well, I think we now have to prepare for a recession in the short term, even though a lot of the long-term drivers of markets, I think, will be similar. So Powell is now being seen as the new Paul Volcker with his tough talk and promised action on inflation. And this front loading of Fed hikes has really restored confidence in the long-term value of US treasuries, if you like. So ironically, more hikes now means a lower rate of interest in the future. And of course, all of this is quite ironic because a few months ago, Powell held the world record for money printing and believed that inflation was transitory and probably still does. Nevertheless, I think we have to recognize that this moves the market on to a new regime, at least in the short term. So the perception of investment risk has moved from interest rate risk or valuations to short-term cyclicality or earnings. And that means that we have to change our own portfolio in terms of pivoting, if you like, against stocks with high valuations to those that are more at risk from the forthcoming economic slowdown. So consequently, we've upped our exposure on the long book to earnings profiles which are largely economically insensitive, that have actually not done that great this year because they've had interest rate risk in terms of valuation. And conversely, we've upped our exposure on the short book to cyclical earnings, and particularly those in Europe, which look most at threat from the forthcoming recession.
Okay. Are we now going into a recession?
Well, our opinion, even before the recent acceleration in Fed tightening, was that Europe and the US were probably already 6 months into a recession. If you remember, Q1 GDP in the US was minus 1.6% in real terms, and the median estimate for Q2 is 0%. So in all probability, the US economy is already in a technical recession as defined for 2 consecutive quarters of real economic contraction. Of course, it doesn't feel like any recession that we've ever experienced because inflation is still high. So even though real economic growth is negative, because you've got such high inflation, nominal growth, which is what companies and employees experience in terms of profits and wages, is still mid-single digit positive. But I think one of the reasons why the Fed has had to be so front-end loaded with their rate hikes is simply because once the recession is confirmed, which may come as early as the Q2 economic release in July, it then becomes a lot more politically difficult for them to continue to raise rates in recession. So it's certainly my opinion that in the near term, the news flow around the economy, interest rates and inflation are going to remain particularly difficult. But actually, ironically, once we're in recession, it then becomes easier for the Fed to put a pause on interest rate hikes and to say they've done enough for now. And therefore, we need the recession, if you like, before that dovish pivot can happen for the Fed and before, in my opinion, the market can bottom out, at least in the near term.
If we are heading back into a recession, why won't this tame inflation?
Well, that's a very good question, Chloe, yet again. Central banks can, of course, exercise control over aggregate demand in the economy, but it's financial markets and companies which control supply. So central banks can always cause recessions, and that will eventually bring down the rate of inflation. But of course, in Western democracies where a permanent recession isn't politically tolerable, they then have to reflate and they find themselves with the same supply bottlenecks. So the supply response may actually have been inhibited by recession. In other words, because, let's say, commodity prices fall in a recession, companies are actually reluctant to spend more money on investing. So if you like, this is what we call a volatility trap, where companies don't invest because of volatility caused by central bank policies. And as a result, you actually get higher inflation in the long term because those supply bottlenecks just don't get dealt with by companies and financial markets willing to let companies really invest to cure those supply bottlenecks. So I think eventually financial markets will find their confidence in central banks' ability to restore price stability misplaced. But I think in the short term, the narrative for the market is that the Fed will keep hiking until they break the cycle. Now, my view is that is a short-term interruption in a longer-term inflationary cycle, but it is nevertheless one that we have to pay attention to in terms of managing the portfolio. I think we're not returning to the kind of deflationary scenario we've seen for most of the last 40 years because those supply side bottlenecks haven't been addressed. And indeed, in all probability, we're going to return to the stop-go cycles of the 1970s. And anyone interested in reading about this in more detail should read our recently published blog, Powell's Play Extempore, which goes into a lot of detail in comparing the current cycle and the current hiking regime to the two failed attempts to cure the inflationary problem in the US in 74, 75, and indeed in 1980, before eventually Volcker got round to doing that in 1981.
And what would you say the fund offers investors, which most other equity funds do not?
Well, Chloe, I think we've heard a lot over the past few years about actual investing and how active fund management is just about simply picking the fastest growing stocks and just sitting on them for decades. Well, we've seen that when macroeconomic conditions change, this is a recipe for disaster. So our view is actual active management, for which we get paid a fee, is to manage the portfolio through the economic cycle and being conscious of the fact that different characteristics in stocks get rewarded and punished as economic conditions evolve. So our long-term view is that the next decade will be largely inflationary, that valuations will matter more, and that the best opportunities are within commodities. But I think we also have to recognize that at any stage, central banks can cause recessions. And recessions, depending on how long and deep they are, usually bring down inflation and are usually bad for corporate earnings and cyclical earnings. So I think what we need to prepare for, certainly over the next few months, is a deflationary scare caused by this central bank action, and the earnings risk will become more elevated versus interest rate risk. Now, in my opinion, this means that we have to evolve the portfolio, because we're entering a new phase of the economic cycle from overheating to recession. And once recession is confirmed, then we can turn more dovish on those cyclical areas of the market and pivot the portfolio back. But for now, I think we need to turn cautious, and this is active management.
Great. Thank you very much for your time, Barry.
Thank you, Chloe.